All right, so tonight we're going to cover something that your financial advisor might not have told you. Have you ever wondered where all the wealthy people put their money? Have you ever wondered why wealthy people remain wealthy? Have you ever thought to yourself, man, I've been doing everything that my financial advisor has told me to do, yet I seem to get further and further away from financial security? Well, tonight we are going to answer all of those questions and at the same time provide a possible solution, one that could change you and your family's destiny today. Yes, today. All right, so let's actually get to the webinar portion of the webinar. And we're going to be talking about Shyft-Capital, where you go to shift your economy. But before we get into the topic at hand, a lot of people like to know who they're talking with. So this next slide, it's my least favorite. But I understand that a lot of people love to know who they're interacting with. So a little bit about me. My name is Josh Tully, as I've mentioned. I am a top 100 business trainer, top 25 business advisor, 3-time #1 best-selling author. I'm a nationally syndicated talk show host, the chairman of 12 companies, Evangelpreneur, by far my best-selling book out of the number of books that I've written. And I've been on other shows as well, doing over 100 different appearances on television and radio, everything from Fox Business to CRTV, The Blaze, Daystar, Al Jazeera, yes, that Al Jazeera, Turkish television, you name it. I've been around for a long time. And I say that not to kind of brag, but just to kind of draw a comparison between a lot of what we see in the internet-delivered content these days, where you have these, what I call Insta experts, who've never really done anything other than become a coach or something weird. And that's simply not the case here. I've been in business, like I said, for 25 years, have owned a number of companies, currently own 12 of them, everything from clinics to jewelry stores to beverage companies, you name it, we've been in it and we've been doing it for a long, long time. So I say that again, not to brag, just to establish some credibility in the topic that we're talking about tonight. I've been doing this for a long time, and what we're going to be talking about is something that in my 25 years of being in business, I've never seen anything that holds a candle to the financial power of what we're going to be addressing. So then what about Shyft-Capital? Well, Shyft-Capital really offers 3 types of services, either through Shyft-Capital directly or our sister companies. We focus on wealth education, wealth creation, and wealth protection. We view this whole financial arena as something that needs to be holistic and complete. You know, a lot of companies focus maybe on one of these, but that's really like sitting on a one-legged stool. It's not going to work. By focusing on all 3, it gives a way stronger sense of stability and financial security. Now, we're going to focus on one of these today, and that's wealth protection. Even though the other 2 are great, we'll offer webinars on those as well. But the topic right now is wealth protection. Now, why wealth protection? Well, Shift Wealth Protection was really born out of a need. We had been placing our clients' financial trust and capital for a long time, for 20-plus years, and we were noticing a scary trend. The options that are typically presented are not really decent or even smart options. Now, we're going to be talking about a lot of things in this webinar, and none of these are necessarily indictments, so to speak, of different options or tools or services, but just an honest, real look at what we have found through our real-life experiences of doing this for what seems like a long time now. Man, time flies. One of the first things we're going to be addressing is banks. Now, we're not opposed to banks. We have bank accounts in multiple banks, actually. There's nothing wrong with banks. But when it comes to financial security and where to put the important money, we just didn't feel confident placing the important money in banks long term. And there's a number of reasons. First, who owns your money? Now, as odd as this might sound, when you deposit money in a bank, you no longer own it. You become what's called a creditor to the bank. I remember I was giving this presentation in front of a few hundred people, and there was a gentleman from Chase Bank there. And I had him stand up, and I said, now I'm going to say something, and you tell me if it's true or not. When people put their money in the bank, they no longer own that money. And he said, that is absolutely true. I know. It's just something that we're not taught. You become what's called a creditor to the bank. Now, for me personally, that seems like a pretty risky sort of situation. I like stability. I like safety. I like knowns. I don't like surprises. And if I had the option of owning my money or giving up ownership to somebody else for them to put in their bank, it's an obvious choice for me. Fractionary lending. Now, this is a topic that justifiably and admittedly is a bit of a hot button issue. The idea behind fractionary lending is a bank gets money on deposit. They lend it out multiple times the amount of deposit. So, for example, if you put in $100 into the bank, they're not going to lend out just $100. Because of banking relationships through the Federal Reserve, they actually get to lend out and issue more loans than money on deposit. That gets problematic quickly. It isn't covered by the FDIC. Now, this, again, is one of those, well, wait a second, Josh, it says right in the window, there's a little sticker. Deposits up to $250,000 are covered by the FDIC. Well, there's a PBS report. It's actually, they did a great job on it. I think it was the PBS program Frontline that pointed out that the FDIC has about $50 billion in coverage. They can leverage up to about another $500 billion if need be, and that's relatively new based on the crisis that I'm about to tell you. And what's that crisis? Well, the FDIC only has $50 billion. On any given day in those FDIC-insured accounts, there is $3 trillion. So they don't even have a fraction of what they would need to really cover this. Now, this was true in a pre-COVID world, of course, but now in this post-COVID world, it's becoming even more and more relevant. Why? Well, because here in St. Louis, when COVID hit, the FDIC and the Federal Reserve were running ads on television, urging people, asking people, please don't take your money out of the bank. Why? Because if it crashes, they do not have the money to cover it. And like I said before, I don't hate banks, but I've asked every one of our bank managers and I think we have 4 different companies that we bank with. All 4 companies have admitted and said, yeah, we are fully aware that the FDIC does not, in fact, have the money they need to cover. And then, of course, the big bank bailouts irritate the bejeebies out of me. I'm kind of a studier of economic history. And we saw big bank bailouts in the Great Depression, where the banks were given money to artificially prop up the stock market. It didn't work, and it ended up crashing even larger than some experts believe it would have if we didn't do the big bank bailout. And then, of course, in 2008, we were all alive for that, and we saw the bailout go to the banks. The idea was we bail out the banks. Now, that's kind of ironic since these are supposed to be the people who have all the money, right? We bailed out the banks, and the banks were supposed to then lend out that money to us to cover loans, to cover mortgages, to cover life. It didn't happen. Instead, what we saw happen was the big banks kept all that money, gave themselves record bonuses, and the excuse was, well, if a financial crisis ever happens again in the future, we're going to need to have the liquid to cover. Fast forward to 2020, so not that far in the future. Fast forward to 2020, and what happened? Another crisis. Did the banks have that capital, and were they ready to cover? No, of course not. Nope. We learned in COVID that it took about 4.5 minutes for us to realize this isn't going to work. So the government once again bailed out the banks. That didn't work. Because why? Well, they weren't passing the money along to us. So the United States government had to go directly to the U.S. citizens and issue that money. I don't know about you, but me personally, I'm a little sick and tired of having to bail out these banks, especially if these are supposed to be the people that I trust with the ownership of my money. And then, of course, what you can buy. Now, we'll get into that in a second, but obviously we knew at that point that this wasn't a good place to keep our important money. This is the general terms and conditions. See, I'm a really big fan of, you don't have to take my word for it, prove it. Well, here's proof. This is from a bank. I'm not going to tell you which one, but if you count the X's, I'm pretty sure you could make an educated guess. But this is true with your bank, too. This is kind of a standard terms and conditions. And this is, when you open an account, this is typically displayed to you in digital format on a little tablet. And instead of reading it, most of us, myself included, Just hit next, 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 and then sign. Well, we decided to print it off. And this is what it says. It says that you, the client, agree that we, the bank, have the rights under this agreement, that they, the bank, are entitled to all rights and protections of this agreement. Not you, not both of you even, just the bank. They, we, the bank, can amend this agreement. It gets worse. You, the customer, cannot transfer or assign rights or obligations. Now, here's where it gets nuts. Payments. They reserve the right to decline payments, whether that's your debit card, your credit card, your checkbook, or a cash withdrawal from the bank itself, on anything that relates to any of these. Now, I know that you might say, well, Josh, they might have put this in the contract, but they don't actually use this section. First, to me, that's 100% irrelevant. The fact that they own the money, they have the right to amend the agreement, and they get to say what I get to spend the money on? No, thank you. But let's just kind of take a look at some of these. Prescription drugs and devices. Prescription, which means legal prescription drugs that your doctor wants you to have. If the bank doesn't think you should have it, then they can deny that credit card or debit card swipe or that check. Not kidding. And if you don't think that's possible, one word for you: hydroxychloroquine. They also reserve the right for goods and services that might include images or language that are bigoted, hateful, racially offensive, vulgar, obscene, indecent, or discourteous. I think we all could agree that none of us want to be bigoted, hateful, racially offensive, vulgar, obscene, indecent, or discourteous. But who gets to decide what is discourteous? A jury of our peers? A judge? The city code? No, none of these things. The bank. Because we just gave them the right to 2 pages ago. They get to decide what is discourteous, and based on their definition, they can decline your debit card. Now, in 2020, what could discourteous be? Not holding the door open for somebody when they enter the bank? Or, let's be honest, it's 2020. Discourteous could be holding the door open for somebody when they come into the bank. So we just knew at that point, too, this is like red flag number 7. Goods or services that advertise, sell to, or solicit others. For some reason, multi-level marketing programs, they got picked on a little bit, too. But this, too, donations or payments to any unauthorized charity or nonprofit organization that they might not agree with. Now, you might say, well, again, Josh, this is in the contract, but they don't actually exercise their rights. First, again, 100% irrelevant. Does not matter to me. If we're going to be a good steward with our capital, does giving all these rights and permissions over to some other entity and giving up control sound like a good steward? Yeah, I didn't think so either. But look, it's actually happening. This came out, I think, the week before the 2020 election. Now, please keep in mind, I don't care who you voted for. I don't care if you're a Democrat, Republican, or you didn't vote at all. This should scare you. A Florida conservative firebrand, Laura Loomer, tells why she was banned from Twitter, PayPal, and Uber, and had her bank account frozen for anti-Muslim hate speech. Now, I am not a supporter of anti-Muslim hate speech. Not at all. But that's not really the point, is it? Who got to decide if her speech was anti-Muslim? A jury? No. A judge? The police? Not at all. The bank. Completely open to their interpretation. I don't care if you are a Hillary Clinton, Joe Biden loving Democrat. That's fine. That's good. Good for you. This should scare you. And she's not the only one. I know other people who host talk shows like myself who have been denied access to their funds at the bank or their payment processor just because the bank or the payment processor didn't agree with what they posted on Facebook. And if you don't think that this can happen, for goodness sakes, remember the athlete. He was a race car driver who got fired, not because of something he said, but because something his dad said in 1977 or 78. Not kidding. So in this crazy world, we realized really quickly, ooh, man, I don't know. Let's protect as much money as we can from this sort of shenanigans. That leads us to the stock market. Again, I'm not going to tell you that the stock market is terrible. Not at all. I'm in the stock market. I play the stock market. I have stock in a lot of things. And I hope, key there, I hope that it continues to grow and I can cash out and yay, yay, yay. But there's some realities to this too when it comes to protecting capital. And that's what we're talking about. We're not talking about where to put money to become rich. We're not talking about where to put money in order to gain an awesome rate of return. We're talking about protection of the money. So when it comes to the stock market, there are some things that we really didn't like. Compound interest, for example. There's this idea that Wall Street-based products are giving you compounded interest. They're not. They're not. I know your financial advisor probably told you about the rule of 72, and Albert Einstein said, there's nothing more powerful than the rule of 72. He's right. Einstein did say that, and Einstein is probably right. But that rule of 72 based on compound interest is not what you see in most Wall Street-based products. Why? Because if they actually paid you compound interest, they would go to prison. Let's say, for example, I buy a stock market-based product. I don't care if it's an ETF, a mutual fund, it doesn't matter. Raw stock. If I buy a stock for $100 and it goes up to $150 in value, is that compound interest? Nope, not at all, not even close. Interest only has two definitions, either increased ownership or cash paid on a financial vehicle. So when a stock goes up in value to $150, did my one share become two shares? No. Did that $50 extra of value get paid to me as a $50 payment? No, not at all. So by neither definition is this compounded interest. Now, to add insult to injury, when I make my next purchase or contribution to my retirement plan, do I get to buy in again at 100? No. I have to buy in at what? 150. Or worse yet, even higher. Thus negating the gain, and I'm using air quotes, the gain that I thought that I made. You're not compounding. You just have an item that is hopefully going up in value, and then you continue to buy more at that increased value. Well, what about dividends? Dividends are paid out, and I can reinvest that. Sure, absolutely. Rock on. Yep, cool. But the value of the stock affects the dividends. First, please understand that most of the largest companies in the stock market, and if you're listening to this at somewhere in the year 2020 up to 2022, most of the companies that are really keeping the stock market up are companies that do not produce dividends. Not kidding. I remember as late as December of 2020, it's six companies that were keeping the stock market afloat, if you will. The whole, the Dow reached 29,000. Yep, 6 companies that were doing it. Quick little side note, isn't it interesting? There's 2,400 companies listed on the New York Stock Exchange, and they can swap out the companies that they want to put in the Dow. Yeah, it's crazy. Crazy. That'd be like playing poker with somebody who's keeping 4 extra decks of cards under the table, and they get to switch out whatever cards they want to make their hand look good. But that's a whole nother topic. When we look at the value of the stocks, it's really fascinating to see how overvalued the stocks are, even according to their book value. And I know this might get a little bit, heady or geeky in terms of economic talk, but just think of this in a real simple scenario. I've been buying, selling, flipping, building, growing, and advising companies now for 25 years. When I buy a company, I look at the company's earnings, and there's way too many ways, in my opinion, on how to base that. But you can look at SDE, you can look at net, you can look at EBITDA, you can look at gross, whatever. You pick some sort of economic earning indicator, and then you multiply that by 3, 5, 7, 10, 15, even in some cases 20, and that number tells you in real cash, not in increased value of the company, but in real cash, how long it's going to take to earn back the purchase price of that company. Well, when we look at dividends and real value, book value, as opposed to stock market value of these companies, what do we find? We find massive companies, whether it's Amazon or Tesla, that pay out zero dividends. Zero, nothing, nada. And I get it. They're reinvesting those dividends to the growth of the company. Great, hallelujah, yes, that's why I'm in the stock market. I'm not saying don't do it. I'm just saying let's understand it. So when we make decisions on how to invest, we're not making that same decision when it comes to how to protect. So when you look at Amazon, they pay out a 0.0% dividend. So what am I hoping? I'm hoping the value of Amazon stock continues to go up, and then I sell it to somebody else. Interesting side note, Jeff Bezos has publicly said 3 times that Amazon is going to go bankrupt. For some reason, investors aren't paying attention, but that's a whole nother story. But in terms of actual time it takes me to earn back my stock purchase in terms of dividend earnings, it would take infinity years. Infinity. Now, even with dividend-producing stock, which is great, yes. Even with dividend-producing stock like J.B. Hunt, a trucking company, you buy a share of that for, say, $98, they pay a 96-cent dividend. So it's going to take me 100 years to earn back that money. Now, I can use that 96 cents to go towards the purchase of 1/100th of a new share, and hopefully that compounds. And that's great and wonderful. Again, I'm doing it. But please understand that the rule of 72 doesn't really apply in this case, because even that is a slow growth position, and that doesn't account for increased taxes, increased property taxes, and taxes outside of just income. It doesn't account for inflation. So just be aware of what's really going on. Then you have fees. Yes, fees. On a typical mutual fund, you have approximately 12 to 14 different fees. And I think it's sad when people say, well, I have a brokerage account online that charges 0 transaction fees. And they say that as if somehow they're not getting charged fees. No, they're not charging you a transaction fee. It's kind of like when you buy a car and they give you dealer price, but they're not giving you wholesale price, wholesale dealer price, incentivized wholesale dealer price. They can show you whatever number they want. The reality is that they're making a profit. You know it. I know it. But in some sort of strange universe we live in, we seem to forget the fact that that's what Wall Street's doing to us too. As a matter of fact, Wall Street, the broker always wins. Really. And more so, the house always wins. You know, I'm not telling you to gamble, but if you go into a casino, it's really interesting. All the games, except for one, are slanted so the house wins. Craps, roulette, slots, blackjack, what have you. It's slanted in favor of the house. That's true for all games except one. There's one game where the house wins every single hand, and that game is poker. The reason why the casino wins every hand of poker, because they don't have their own money at stake. They don't. If you go into a casino and watch a poker game, what you're going to see is the dealer will deal. Everybody will ante put their money in the pot first. The dealer will then take his or her hand, reach out, grab a portion of that pot, and put it in a locked box next to their seat. That's the house's cut. The house doesn't care who wins. The house can't lose money. It doesn't matter who wins or who loses. The house makes a cut. Well, Wall Street, and I'm using that broadly, whether it's New York Stock Exchange, NASDAQ, the Nikkei, whatever, they are for-profit generating machines. And oddly enough, it means they actually make more money in a crisis than they do in good times. Why? Because in a crisis, people sell. So, there you go. Now, Jack Bogle and Vanguard, this is a quick little story. You can look it up for yourself. There's an interview that Tony Robbins, the motivational speaker, did with Jack Bogle. Jack or John, whichever name he goes by at the moment. He actually recently passed away, but he managed Vanguard. Vanguard is the largest mutual fund company in the world. They manage trillions of dollars in assets. He would spend more by lunch on Monday than the entire net worth of Jeff Bezos. Absolutely amazing. But he said in an interview once, Tony Robbins, and I'm kind of paraphrasing, but he said, Jack, let me get this straight. What you're telling me is Wall Street's really a racket. It's a bet. Yes. And it's a bet where basically you, the money managers, come to me and say, hey, give me your money. I'm going to go bet it. And if I win, you get some of it. And if I lose, you still pay me. And Jack said, yeah. Who would do that, Jack? Yep, exactly. And then, of course, March 7th, we've seen what happens. March 7th, 2020, we've seen what happens when there's too much of a crisis. They just close the casino down. And then we get to this average rate of return in the 15 to 30-year returns. If you've been told, well, just put your money in the market and let it ride for 15 to 30 years, and that's how you really make money in the market, no, not really. Not statistically, anyway. As a matter of fact, let's cover this first. We'll get to this average rate of return in a second, but let's cover this first. Back to the interest portion. This is the actual definition of interest. Interest in finance and economics is the payment from a borrower or deposit-taking financial institution to the lender or depositor of an amount above repayment of the principal sum at a particular rate. It is distinct from a fee in which the borrower may pay the lender. It is also distinct from a dividend. What does this mean in reality? Well, it means that compounding interest isn't really happening in Wall Street by their own definitions. Compounding interest is the interest on a loan or deposit calculated based on both the initial principal and the accumulated interest from previous periods. Wait a second. Well, neither one of those things happen when you invest in a market-based product. Exactly. So you don't have to take my word for it that Wall Street isn't paying you compounded interest. It's actually illegal if they did. But let's get back to this average rate of return. This is why you never want to listen to averages. The word average is really where people pull off money magic. Let's say you buy something for $100, a stock you like or a mutual fund. It goes up 50%. Woohoo! Happy days. It's now valued at $150. Then the market goes down 40%. It's now valued at $90. But you know what's nuts? I can tell you made a 10% average yield, even though you have $10 less money. Now, what's really crazy is you spread this over 15 to 30 years, and it gets super ugly. It gets super ugly, which is part of the reason why so many millions of Americans have fell for this just crazy idea of buy term and invest the difference sort of scenario when it comes to how to become a wealthy individual. Want to talk about real examples? Here we go. Here's Jim. Jim's portfolio, he starts withdrawing, right, at 66. He's going to retire. He starts with $500,000. He takes out an inflation-adjusted withdrawal rate of 2.5%. We are using the actual S&P index fund numbers from 2000 to 2015. The 15-year period gave an annual average rate of return of 3.77. Well, Josh, that guy on the radio told me he's getting 12. Yeah, if you go to that guy's own website, see the little citation marker next to that claim and click it, he actually tells you, no, I don't. There's a huge difference between the actual rate of return and the average rate of return. Anyway, but this is the actual number from 2015. He's taken his withdrawals, and at the end, at 81 years old, he has $344,290. Well done. Well done. Yay. But you don't know when the negatives are going to happen, and you don't know if that's going to be at the beginning, middle, or during your retirement age. So let's take the exact same scenario and put it on Jane. Jane has the same $500,000, same inflation-adjusted withdrawal rate, same S&P index numbers, same rate of return. The only difference is timing. Timing. Jane decided to retire at a different time, get invested at a different time. So what happens? At the age of 81, Jane has $74,300, and she has to go be a greeter at Walmart, even though she saved up and did what she was supposed to do, and rule of 72, and we're getting a great 7% return, and whatever, got her to $500,000 when she got to 66. Oops, didn't work. Why? Because it's not protected. For goodness sakes, this market is so volatile that there is a ticker on the bottom of the news screen telling you by the second what's going on. Does that scream safety to you? Yeah, me neither. As a matter of fact, wealthy people do not put their money in the stock market. Nope. See, we've been told that they do. We've been told, well, wealthy people, that's where they put their money. and that's where I put my money. No. If you have $1 million or more, the reality is that less than 5% is typically kept in the stock market. How much of your retirement is based in the stock market? Yeah, exactly. So just to kind of recap before we get into a third option, what happens when Bob here puts $100 in the bank? The bank lends it out, and even though they lent it out, what does Bob's balance say? $100. This is a really important concept to understand. Otherwise, what I'm about to say is going to sound totally out of left field, and you're going to go, what? If Bob puts $100 in the bank, that bank lends it out to Sally to buy a bicycle, his balance still says $100. So we started asking ourselves, when we were looking for a place to put our money that was safe and secure, while we look for other places to invest it, where does the bank put their money then? And you know, oddly enough, it's not the bank. I know, you would think it would be. It's crazy. Where do Wall Street people put their money? Wall Street, right? No, not at all. I have a video that I share in our live classes of Warren Buffett saying that this diversification in Wall Street is for idiots, and he only owns one stock. A what? Yep. If you have $1 million or more, most people with $1 million or more outside the value of their primary residence do not keep their money in the stock market. The stock market has become the number one way to extract wealth from the middle class. It is absolutely appalling in some cases. Now, if you're going to play it, that's a completely different scenario. Play. But realize that it is exactly what it is. It's a bet. So we started looking at, where do these entities put their money? They put it with insurance companies. Now, please understand, when I say insurance companies, I am not talking about what most people would see in the world, the retail sort of insurance, the State Farms, the Allstates, the American Families, the Progressives. There's nothing wrong with those companies. Nothing. Please, please, please let me make that point clear. Nothing wrong with those companies. But that just represents a tiny fraction of the insurance industry. And if you're an entrepreneur, you know that. You know that you have slip and fall insurance, you have E&O insurance. A great example that most people could understand, the Mona Lisa in Paris, it's insured, obviously, but I can promise you that it's not insured by 1-800-GENERAL now, right? Beyonce's voice, it's insured, but I guarantee you it's not insured by Flo from Progressive. There's nothing wrong with retail insurance, but take what you know about retail insurance and just set it aside for a second, because that's not what we're talking about. Now, why do wealthy individuals, wealthy nonprofits, wealthy companies, and banks and stockbrokers, why do they put their money with insurance companies? Because it lets you do something that is absolutely insane. It lets you borrow out. Yep. So let's say Bob here puts $100 with the insurance company. He then borrows out $100. What does Bob's balance say? $100. Oh, no, Josh, that's too good to be true. Was it too good to be true there? No. No. Put your $100 in the bank, they lend it out to somebody, your balance still says $100. Same is true here. As a matter of fact, this is a very popular way, and it has been for over 100 years, as to how wealthy people remain wealthy. This is from Berkshire Hathaway's own website. You can go on their website. It's called the Investor Playbook. Quote, besides, Berkshire has access to 2 low-cost, non-perilous sources of leverage that allow us to safely own far more assets than our equity capital alone would permit: deferred taxes and a float. The funds of others that our insurance business holds because it receives premiums before needing to pay out losses. Both of these funding sources have grown rapidly, now totaling about $170 billion. Better yet, this funding to date has often been cost-free. Deferred tax liabilities bear no interest, and as long as we can break even on our insurance underwriting, the cost of the float developed from that operation is zero. Even the Motley Fool ran an article, Warren Buffett in the Insurance Business, a 52-year love story. I find it so funny when people think, well, he's the Oracle of Omaha. He makes money on Wall Street. Nope. He makes money by putting your money in Wall Street. And his money is in insurance companies. Not kidding. As a matter of fact, the banks are the same way. There's about 5,400 banks in the United States. And as of third quarter of 2019, you can go look at FDIC.gov. You don't even have to believe me. It's right on the government website, for goodness sakes. You just weren't taught about it. Almost 3,800 banks own $190 billion in insurance. Every national and every regional bank has their money in insurance companies. Absolutely crazy. Why? Why? Because insurance offers you real compounding interest. Yes. When an insurance company pays you a dividend, they pay it to you in cash. Remember, interest had two definitions: either cash paid on a financial tool or device, or increased ownership of something. Well, when an insurance company pays you a dividend, they pay it to you in cash. Or you have the ability to say, I don't want the cash, give me more ownership. So by both definitions, it's hitting interest. The insurance we're talking about can't lose value. It doesn't go backwards. That's why it's safe enough for Wall Street and the banks to put their money there. It offers tax-free growth. Now, I get it. Somebody listening to this is probably going to say something silly like, oh, there's nothing that's tax-free. That's too good to be true. That's one of those things. Nope, not at all. As a matter of fact, every single person watching this webinar knows for a fact that interest is tax, or that insurance is a tax-free entity. You know it. It's not too good to be true. You just weren't taught about it. How do we know that? Well, I'm hoping that your car is insured. And if you crash your car into a mailbox and the insurance company sends you a $4,000 check to fix it, do they tax that? Nope. If your house burns down and they send you a $200,000 check to fix it, do they tax that? Nope. When grandma dies and leaves the kiddos $10,000 in a life insurance policy, do they tax that? Nope. See, every single one of you knows that insurance is tax-free. You just weren't taught to use it as a tool. It protects you from creditors. Let's say you have $100,000 with an insurance company, and there is this, pandemic. And all of a sudden, your business is going out of business, you lost your job, they're repoing the car. Guess what? They can't touch the money you put with the insurance company. It's also safe from bankruptcies in most U.S. states. I think it's 48 out of 50 or 47 out of 50. It's even safe from bankruptcy. It gives you two assets in one. We'll talk about that in a second. Insurance doesn't crash. Insurance doesn't crash. Now, have insurance companies gone out of business? Sure. That happens no matter what. I mean, people sell, people close. But you've heard of 47 stock market crashes. You've heard of 41 bank savings and loan and credit union crashes. You've never heard of the great insurance crash of 19 never. Why? Because insurance isn't based on markets as much as it's based on math. I get asked a lot, how do insurance companies make money? It's really simple. If 100,000 people own homes in your city, they all have homeowners insurance. How many of those houses get burned down or get destroyed by a tornado every year? 5, maybe? 10, maybe? That means 99,990 of those are profit. Yep. Insurance companies, sure, they invest in stuff like real estate and bonds and treasury bills and all that, but they also make money based on math, not market. It protects your other investments. So real estate investments, 401k contributions, gold, Bitcoin, ranch land, what have you. It can help protect those other investments, and it also gives you quick access to cash. So here's the difference. Again, there's nothing wrong with retail insurance, nothing at all. My Harley's insured by State Farm, and my business is insured for loss from, I think, Mutual of Omaha, I think, or something. Yay. Nothing wrong with that at all. And they sell insurance. That's great. What are we talking about? Well, we're talking about, yes, insurance, but also the security, the tax-free growth, the liquidity, the protection, the legacy, and, of course, the strategy that comes along with it. When people say, well, what is this? What are you even talking about? We're talking about a specially designed, non-direct, mutual participating, permanent, strategic whole life form of insurance. This is not something your normal whole life insurance provider can provide. So let's take a look at what this looks like in a real life example, okay? Let's say this is Sally. Sally's 34 years old, and you're going to notice some things. First, all these letters up on top here, if you can see my cursor. We'll explain those in a little bit, but then you're going to notice two other things, guaranteed and non-guaranteed. Now, I've been around for a while, as evidenced by the gray in my beard and the fact that I've been an entrepreneur for 25 years, and I can tell you that hardly anything has this word in it in black and white. Now, this isn't our guarantee. This is the guarantee right from the underwriting companies, the carriers. Now, this to me really makes this a game changer. If you invest in the stock market, mutual fund, 401k, whatever, you're going to sign a multi-page document telling you how it's not guaranteed. Actually telling you, you know this isn't guaranteed, right? It's crazy how people are like, well, that's a safe place to put my money. No, you just had to sign something that told you it wasn't guaranteed. The same thing is true even with a mortgage. You're going to sign how, well, this isn't really guaranteed. We can call this due at any time. You know, it's just nuts. But in my 25 years of being in the financial industry, do you know how rare this guaranteed word is? So that's there. Then there's this other column, non-guaranteed assumption, 100% of current dividend scale. What does that mean? Well, this particular company has been around for about 115 years. Yes, insurance is really that old and really that stable. As a matter of fact, insurance goes back 6,000 years. The ancient Chinese, the ancient Greeks all implemented insurance. It's amazing. It's even referenced in some of the Babylonian texts. It's phenomenal, really. So this company's been around for about 115 years. This is what they actually have been paying. This is what they actually do. That's how transparent and solid insurance is. They have a guaranteed column, and this is what we actually have done. So let's take a look at this. You'll notice a few things. First, this isn't an increasing premium sort of product. So this isn't an IUL, it's not a VUL, it's not a term, it's not a traditional whole life. No, this doesn't go up. In addition, you don't pay for this for forever. Oh my gosh, how crazy would that be? In Sally's example here, she places $100,000 with the insurance company. Wait a second, Josh, you're telling me this is costing her $100,000? No. When you deposit your paycheck in the bank, and let's say you deposit $1,000, do you leave the bank going, man, it cost me $1,000? No. You're thinking about regular retail insurance, like by term or something. That's not what we're talking about. Let's follow this column over here. At the first year, she has access to 80% of this. Now, this varies. I've seen this as high as 87%, but it's all based on situation and health condition and all that. But anyway, this is cash. This is liquid money. When people say, well, what's the catch? What's the hook? What's the part you're not telling us? That's it. She places $100,000. She has access to $80,000. That's the hook. Now, why? Well, because they're leveraging risk here. Because what she really bought was $4 million. That's what she actually bought. So let's just paint a scenario. Let's say you're walking into Walmart and there was a bag of money and it said, for sale, $4 million. And it was real. Price tag, $19,600. How many of you would go find $19,600 in order to buy $4 million? All of us. You'd be flipping over couch cushions trying to find pennies to put together to buy the bag of money. That's what she bought. Not kind of, not maybe, not only if it works. Nope. See right here? Guaranteed. She bought it, baby. So, to leverage that risk, this is so permanent that let's say she does this, 4 seconds after she signs the paperwork, she gets hit by a bus. Her husband and heirs get paid $4 million. That's the catch. That's the risk. Now, as you'll see, she makes it all back anyway. In her case, by year 6, she's getting more credit than what she's putting in to begin with. So it all comes back. But when people are like, well, there's got to be some catch. There it is. Leveraging the idea that you're not going to die that first year. Now, you'll notice some other things. The first one being, like I said, she doesn't put in any premium payments after year 8. Can she? She can if she wants. This is her strategy, because this becomes just a revenue-producing machine. Because look at this. No more contributions. Oh, wait a second. Increase cash value. She made $28,993. Now, this isn't a running total. This is yearly. She made $28,993 tax-free because she's keeping it in the insurance company. Now, what does that mean? How does that work? Check this out. This will blow your mind. When I first learned about this, I didn't sleep for 2 days. Not kidding. You can ask my wife. I didn't sleep for 2 stinking days. Let's say we're in year 3, and she has $260,000 in accessible cash. She can either withdraw some of this, totally legit. She can withdraw some. The only thing that'll happen is this death benefit will go down proportionally. That's fine. But she can also borrow against it, loan it out. So just like the bank, if you have $100 in and they loan it out, your balance is what? $100. Same thing is true here. Let's say she finds a nice multifamily dwelling she wants to invest in. She borrows out $100,000. Her balance says $260,000 still. Yes, really. She buys the multifamily dwelling, and she has $260,000 sitting in here chunking up real compounding. Yeah. That's a game changer. If you are a family, if you are a business, if you are a nonprofit, your financial situation just changed. Now, here's what's even better. If she went to the bank and borrowed out $100,000, they are going to ask her, well, proof of income, proof of job, proof of credit score, how are you going to pay it back, right? Bob Hope has this wonderful quote that said, banks will gladly lend you money as soon as you can prove to them you don't need it. It's absolutely true, which is why 50% of loan requests are denied. This is the complete opposite. Who does she ask? Herself. It's right in the contract. The insurance company can't deny it. She looks in the mirror and says, hey, Sally, can I borrow $100,000? Why, yes, Sally, you can. Now, again, doesn't matter if she has a 320 credit score and hasn't worked in 7 months. Doesn't matter. At the beginning of COVID, I got this terrible phone call from a man just crying on the phone. And he had $400,000 of paid-up equity in his house. He got furloughed from his job. He went to the bank to try to borrow out $20,000 against his house because he needed the money to keep them afloat. Do you know what the bank said? Nope. Why? Because he doesn't have a job. He has no way to pay it back. And he's crying. He goes, man, my parents taught me buy a house because there's nothing smarter than building up equity in your home. It's like putting money in the vault. Nope. The bank will lend you money as soon as you can prove to them you don't need it. This is the exact opposite. In addition, if she did borrow money from the bank, when does that first payment start? The very next month. In this situation, it is up to her. She can look in the mirror and say, you know what, I don't want to pay next month. Okay. Well, I don't want to make my first payment in a year. Okay. Well, I want to make my first payment in 10 years. All right. Well, I don't want to make a payment. Okay. Ever. Okay. Why is that possible? Because she bought $4 million. That's what she actually bought. So worst case scenario, let's say she borrows out $100,000. She buys the multifamily dwelling. She gets hit by lightning and dies. She never paid the $100,000 back. What do? They take the $4.7 million that they owe her husband. They deduct the $100,000 that they borrowed against her leverage here, and they pay him $4.6 million tax-free. Yay! If you grasp what I just told you, your world just changed. Not maybe, not kind of, it just changed. Now, how can you use this? In as many ways as you can possibly think of. It is crazy how powerful this is. Let me give you a couple examples. We're working with churches and nonprofits and synagogues and temples because here they get donations, right? The donations come in. They take those donations, run it through a policy, borrow the money right back out to pay staff and rent and lights and heat. But you keep the entire amount snowballing then. It just keeps growing. And you paid your bills. Now, in addition to that, when the pastor dies or the board member dies or the deacon dies, you now get this massive injection of capital. So now it doesn't matter if your nonprofit or your church never gets another donation ever. It's going to get wealthier and wealthier with every subsequent generation. Another example. We have an employee here, or we had, and that's key to the story. We had an employee here who worked here for about 6 months. My employment contract says if you work here, I get to have a policy on you. Not unusual, actually. If you've ever owned a large business, it's actually in many cases required. But anyway, she worked here for 6 months. I would take her paycheck, put it through a policy on her first, borrow it out, and then pay her. And because she worked here for 6 months, at some point in the future, and I hope it's a long time, but at some point in the future, my company or my heirs are going to get $500,000 tax-free because she worked here once for 6 months. Yep. Now, I had two options. Either A, I take the money and pay her, and then I'm out all the money, or I take the money, put it in a policy, make a compounding rate of return, borrow against it, still pay her, still keep the compounding rate of return, and get the death benefit when she does pass away. It's kind of a no-brainer. So that's what we're talking about with Shyft Wealth Protection. Well, Josh, does it work for people who don't have $100,000? Sure, yes. Let's take the same Sally Sundress. Let's say she's a manager at a Chick-fil-A and a single mom for two, right? She places $24,000 with the insurance company. She has access to $20,000 of it. Her rent is $15,000. She borrows out $15,000 to pay this year's rent. Now she keeps the entire $20,000, making a compounding rate of return, and she pays rent, and she's leaving $1 million to the kids with the same money. We can do a stretch IRA, where if you have an IRA with no more contribution than what you're already doing to your IRA, we can stretch that puppy and get up to a 40% increase long-term cash result without changing any sort of additional money contribution. We're not talking about extra money or finding extra money or this is the investment. No, we're talking about the money you have. Let's protect it and strategically use it to the benefit of your real goal. And by now, if you're grasping this, you understand how this literally, not kind of, not maybe, how this literally changed your financial trajectory. I don't care if you're a single mom managing a Chick-fil-A. I don't care if you have $500 million in the bank and you're the CEO of Forbes or a Fortune 500 company. Doesn't matter. We just changed your destiny. So that's it. Really, that's it. At this point, typically I take questions and answers if we're doing this live. The benefit is, if you're watching this in the webinar version, we have recorded a number of our most common frequently asked questions, so feel free to answer that. If you're watching this and an agent referred you, get back with the agent that referred you, and they can answer all these questions for you. They can even run one of those illustrations for you without any commitment. They can just run one to show you what your specific financial scenario would look like. And they can help you with creating those legacy sort of financial plans, the stretch IRAs and stuff like that. If somehow you got this webinar some other method, well, first, we're glad you're here. Welcome. You can contact us also at info@shyft-capital.com. Shyft being spelled like it is spelled on the bottom right of your screen, so Shyft-Capital.com, info@Shyft-Capital.com. Thank you so much for spending some time with us during this webinar. I know it was kind of lengthy, but I also know the power that it has. We have saved our families and our clients and our businesses that are working with us well over $30 million in long-term capital, and our clients during COVID have not lost a single dime. So while this might have been a long webinar, you and I both know that it just changed everything, and it was well worth it. Thank you for the time. Hey, thank you so much for watching. And look, I know there are a lot of things out there. Everybody has something that sounds cool. I get it. I know it. I've been doing this for 25 years. Look, if this works for you, great. If it doesn't, great. We do a lot of other stuff, so I know we have something for you. But I do want to make sure that you have all your questions answered. If an agent sent this to you, make sure you get in touch with them. And if an agent hasn't sent this to you, then feel free to contact us at the information provided. Either way, again, I thank you for the time, and I'll see you next time.